Welcome to QIP Capital, where we break down finance and investing so you can make smarter money moves. The world of investing can feel like a different language when you're just getting started. IPOs, stop losses, bear markets. It can get overwhelming fast. But the good news, once you learn a few key terms, everything starts to make more sense. In today's video, we're covering 9 essential investing terms that every investor, beginner or experienced, should know. Let's dive in. 1. Capital markets. Capital markets are the financial arenas where companies raise money and investors put their money to work. This includes stock markets, crypto platforms, bond markets, and commodity exchanges. When a company wants to grow or expand, it can raise money from the public in these markets. At the same time, investors get a chance to invest in these businesses and potentially earn returns as they succeed. Think of it like a giant financial matchmaking platform, connecting those who need capital with those who have it. 2. Investment portfolio. Your investment portfolio is like a basket of all the assets you own: stocks, bonds, ETFs, crypto, or even cash. For example, if you own Apple stock, US Treasury bonds, and some Bitcoin, together, those form your portfolio. The idea is to build a balanced portfolio based on your goals and risk tolerance. Some assets for growth, some for income, and others for safety. 3. Index. Index is a group of selected securities that represents the performance of a specific market or sector. The S&P 500, for instance, tracks the 500 largest publicly traded companies in the U.S., like Apple, Amazon, Microsoft, and Google. If the S&P 500 goes up, it usually means the overall U.S. market is doing well. Indexes are also useful because you can invest in them through index funds or ETFs, making diversification easier for everyday investors. 4. IPO, initial public offering. An IPO happens when a private company sells its shares to the public for the first time, getting listed on a stock exchange like the NYSE or NASDAQ. For example, when Airbnb went public in 2020, its IPO allowed regular investors to buy shares and own a piece of the company. IPOs can offer exciting early investment opportunities, but they also come with risks, as the stock's price can be volatile in the early days. 5. Dividends. Dividends are a portion of a company's profits paid out to shareholders, usually in cash, but sometimes as additional shares. For example, if you own 100 shares of a company that pays a quarterly dividend of $0.50 per share, you'd receive $50 every quarter, just for holding the stock. Dividend-paying stocks can be a great source of passive income, especially from stable, established companies like Coca-Cola or Johnson & Johnson. 6. Volatility. Volatility refers to how much an asset's price moves over a certain period. A stock that jumps from $50 to $70 and back to $40 in a short time is considered highly volatile. Volatility can be scary, but it also creates opportunity. Traders may look for high volatility to profit from price swings, while long-term investors may prefer low volatility, steady growth assets. It's all about knowing your risk tolerance. 7. Bull market versus bear market. These terms describe the overall direction of the market. A bull market is when prices are rising steadily, investor confidence is high, and the outlook is optimistic. For example, the U.S. stock market was in a bull run from 2009 to 2020. A bear market, on the other hand, is when prices drop 20% or more from recent highs, like during the 2008 financial crisis or the COVID-19 crash in March 2020. Knowing which phase we're in helps you adjust your investing strategy accordingly. 8. Going long versus going short. Going long means buying an asset expecting its price to go up. You profit when the value increases. This is the most common investing approach. For example, buying Amazon stock today because you believe it'll be worth more in the future is a long position. Going short means you believe the asset's price will go down, and you profit from that decline. This is called short selling, and it's more complex, often used by traders. It's important to understand both. even if you're not actively shorting. 9. Stop loss. Stop loss is an automatic sell order you place to limit your losses. It kicks in when the asset drops to a certain price. For example, if you bought a stock at $100 and you don't want to lose more than 10%, you can set a stop loss at $90. If the price hits $90, it automatically sells, protecting you from further losses. It's a great way to manage risk without needing to watch the market all day. Wrap up, and that's it. Those are 9 key investing terms you need to know to build your financial foundation. Whether you're managing your own portfolio, getting into the stock market, or planning for the long term, understanding these terms will help you make smarter, more confident decisions. If you found this helpful, like the video to support the channel. Subscribe to QIP Capital for more practical investing content. Share it with a friend who's starting their investing journey, and comment below which term was new to you, or what would you like us to explain. Next, thanks for watching, and as always, invest smart, invest confident.